Jordon, thank you so much for joining me here at SuperInvestor. You've come fresh from a panel talking about the challenges that this industry has been facing over the last 12 months. And I guess strategy and the teams you have will be key, because you're perhaps looking at something that's portfolio company related rather than economy related in terms of where you find those returns.
Yeah, absolutely. I mean, it's really the case that you have to be on a daily basis active in sourcing new opportunity, active in underwriting, and active in portfolio management. And that means assessing your portfolio where it sits on a daily basis. And that's a constant conversation. You know, something that might be good for one portfolio company might not be good for another portfolio company. So how are you going to assess the risk associated with that and change something within that portfolio company so that it can continue to grow, right? The key to this business is you got to grow the revenue and earnings of your portfolio.
And you've talked about that sort of volatility actually being quite helpful if you've got the right team. And you've obviously got your specific dedicated special situations group. Tell me about that and what you're focusing on in that sort of environment.
Yeah, well, I would say in the last 2 years, our opportunity set has been probably the closest thing to good company, bad balance sheet that we've seen since the early 2000s. I mean, when I started at Oaktree, we described our strategy as a good company, bad balance sheet strategy, and really in a high growth, strong financing environment, zero interest rate environment that we've effectively had, save some windows in the last 20 years, it's been more okay company, bad balance sheet. The opportunity set has been leverage plus something idiosyncratic happening to a business that creates the opportunity. The last 2 years, it's been more companies are growing, but because of interest costs, they just can't handle their current balance sheet, and that creates opportunity. I don't know where it goes from here, although I don't think the interest rate environment is changing anytime soon. And so if you take that as your base case, you would think that good company, bad balance sheet opportunity will continue, and then you layer on volatility into that, and now you're going to get some more idiosyncratic challenges.
You sort of touched on it there, but what specifically would you say are your SSG sort of looking for in potential investments then, and how do you find that value? You talk there about, you know, obviously sort of good company, bad balance sheet, and is that the key? What are you looking for?
Not necessarily. It's just that's the opportunity set in this environment, has been the consistent opportunity set since the Fed started raising interest rates. Because, you know, there are definitely companies that haven't performed during this period of time, but there are many, many companies that have performed well, but because of interest costs effectively doubling during that period of time, the underwriting was such that you could handle 7 times debt at S plus 450, S plus 500 if interest rates were at 0 to 2%. If the interest rate's at 4.8 to 5.5%, you can't handle that interest cost. So that's great. We love that opportunity. We'll take advantage of that opportunity. The other thing we look for is businesses that we think really have a reason to exist, that we think through active ownership we can grow their revenue and earnings over the life of our investment, but something specific happened to that business that caused the debt structure to be a problem, and that creates the opportunity to invest. So we're relatively indifferent to what creates the opportunity. It's just that the opportunity must be one that we would characterize as special situations, which really is just value private equity investing. At the end of the day, are we buying it in a downside protected way where the risk of loss is low, but through that active ownership, because that business has a reason to exist, we can grow the earnings profile and capture that arbitrage on the back end.
And would you say that there's any typical sectors or geographies that you're most or less interested in because of perhaps there being volatility in that region, or sectors that are more susceptible to those economic risks?
Sure. So I would say that we're industry agnostic. Historically we've done a lot in industrial manufacturing. That's a broad set of subsectors. Consumer products, broad set of subsectors. A lot in financial services, a little bit of healthcare, some gaming. There's really no industry we won't look at. I would say philosophically, and this sort of belies the nature of special situations, but we really don't chase industry level distress. Industry level distress, and what I mean by that is the revenue and earnings profile of every company in the industry is on the decline, is usually created by either some external factor like a commodity price, so if you think of oil and gas or shipping, or some structural change to the industry, retail being a great example of sort of industry in distress the last 5 years. For us, that's really not what we do. We're not trying to make a bet on a single factor that will change over the course of our investment period. Really, If you believe the price of oil is going from 70 to 150 in the next 3 years, just go buy calls on oil. Don't invest in a company and interject a management team into it. Similarly, we're not really here to judge how fast an ice cube melts. Because if you get it wrong, you're probably going to lose all your money.
You want it to be much more nuanced than that, and I guess you're very proud of your teams that you have to be able to do that.
Absolutely. I mean, the key to our model is, well, the team is the key to any model, but the key to our model is we have these internal operations folks that go into our portfolio companies and drive performance improvement. If it's an idiosyncratic problem that created the opportunity, it's really addressing what that problem was and trying to reverse that to get the business growing again. But even in the absence of any specific issue that's created the opportunity, middle market companies always have opportunity for improvement. So that is really a critical aspect of our model. We think it's pretty differentiated in the distressed special situations world. Obviously, many private equity funds have operations team, but what we think we've done with this model is created that intersection of credit and private equity, where the focus on making the investment is very credit oriented. But once we get ownership of the business, we're operating like a private equity fund.
Just finally, Jordon, it's a very interesting week to all be coming together with a new president in the White House. So what would you say are your sort of predictions, if you like, for the next 12 to 24 months? And what are you excited about in terms of what this industry can do in that environment now?
Well, I mean, I'm particularly excited because I think that the likelihood of interest rates declining dramatically from here is very, very low. And that really has been our lifeblood for the last couple of years, right? It's been to steal my chairman's words, it's been a sea change, right? Interest rates we expect will remain elevated. I mean, I would have bet a year ago that we'd get back down into the 2.5% to 3% range of base rates. I don't know in a Trump administration that happens. If it does, it's fine. If it doesn't, fantastic, because it will just continue to create opportunity for us.
Always great to hear your thoughts. Thanks so much for sharing them with me.
My pleasure. Thanks.